It's Wednesday, May 3rd, 2023, Episode 2 of the new Market Huddle Plus. I'm Patrick Ceresna. This week, we have the pleasure of welcoming back an old Market Huddle favorite, teaching macros, Tony Greer. We will get his thoughts on this week's FOMC meeting, the jobs numbers, and we'll discuss some of his favorite investment ideas. A quick but important announcement, Cuppy will be in Toronto, May 9th. And although I can't join, Kevin will be hosting a mini Huddle piss-up with Cuppy and for our listeners to join them for a beer. However, there is a catch. Cuppy wants to hear your trade ideas. So to gain entry, you need to submit a trade idea. We will tweet out the instructions on the Market Huddle account, so sharpen your pencil and send Cuppy your best trade ideas to share with other Huddle listeners, and then join Kevin and Cuppy for a fun night of drinking and talking markets. Quick disclaimer, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned on the show. Side effects of too much huddle may include premature accumulation, FOMOphobia, and post-OPEX droop. Let's get to that interview with Tony. So joining me now is a Market Huddle favorite, Tony Greer. It's so great to have you back on the show, bud.
Patrick, great to be here, my man. It's been too long.
Oh, it's been way too long. And you know what? You're one of the true huddlers because you're going to crack a beer with me. What beer are you drinking, bud?
Oh, yeah. I went back old school. I'm back on Guinness now, Patrick.
Love it.
Yeah, I'm going to crack this one right. There we go. A Guinness draft right into the old mug right here.
Oh, that's awesome.
Yeah.
Listen, let's jump into this and talk some charts. You know what, Tone? We have a news-packed week. The FOMC, the ECB. We have jobs numbers coming at the end of the week. Just wanted to get your thoughts. Let's start off with that FOMC. The CME is showing an 85% chance of a hike, which basically means it's more or less baked in. But what's next? How do you think this all plays out, bud?
Well, I'm looking at it, Patrick. The FOMC, the hike sounds like it's going to be out of the question with the new set of bank failures or the new set of bank stress that we dealt with today. I feel like this might be something that could, we just essentially, nationalize First Republic. There's more stress on the regional banks today. I wonder if they can't put the brakes and do nothing, at the next meeting. I'm skeptical about a hike coming. And I think generally speaking that yields are going to be heading lower. I'm still, I think that's sort of what the market's telling us a little bit. It's obviously we're going to navigate our way a little bit through some sort of recessionary economic data that seems obvious. I mean, I know it also seems consensus, but it also seems like it's kind of going to happen also. And I still think that rates are just going to be on, have pressure to the downside, more of what we see today. I think the inflation, what the Fed has done to fight inflation in terms of slowing down the economy has obviously worked. The commodity sector has backed way off. Break evens have backed way off. So it's taken all of that inflationary sting out of the market. Now it seems like we're rather dealing with, a more deflationary issue, if that's fair to say, if we're having layoffs, and we're having a lot of bank stress. So that's really how I'm looking at the FOMC right now.
Okay, so now, sure, they might not even raise rates, or even if they do raise, they might pause. But do you think that they remain unchanged for a while, or do you actually think that we're going to see them start cutting rates sooner than most expect?
I don't think we're going to see them cut. I think that's going to be a very slow process. I think in the background, Patrick, they know that, inflation is there. They've done a great job battling the headline number down from the highs of 9% down to, wherever we are now, a 5 or 6% handle. But I don't think that, you're going to put that genie all the way back in the bottle. And so that's why I think the Fed is going to be very measured in terms of their language and their next move and how they pivot from tightening to easing, et cetera, et cetera. And I just, I have my doubts that they're going to be able to put another hike on the tape. If they do, it looks like the S&P may not take it very well. So that's really, I'm really much better at reacting to the FOMC stuff than predicting it, though, Patrick. I'll be totally honest with you.
Fair enough. You're a trader, and that's the way we work.
Exactly.
So let's move on, though. I wanted to obviously there's the jobs numbers coming out on Friday, and the idea is that we might see is finally a crack in the economy where some of the unemployment levels start to rise. Do you think that this is the month that we start to see a crack in this jobs number?
Yeah, again, it's hard for me to tell, but the way that they've been going, it seems like we're due for it seems like the jobs data has been all very benign despite the layoffs that you read about in the news. You know what I mean? Like it doesn't seem like we've rocked the employment number that much. It doesn't seem like we have too much of a labor issue. So that's another thing that I kind of I let the chips fall, Patrick, and try to react to what happens after that. I have to be totally honest.
So the S&P 500, I have a chart up here
Yeah.
that is showing we tested 4,200 back in December. We went up
Yep.
to that level again in February. We went there again in April. Here we just the other day, we're back up to this 4,200 level. And this today, another round of selling that comes in there. What's your overall sense of these markets and this and what's going on here in the S&P?
Yeah, great question, man. It's really tricky, a really tricky year with let's call it the twos tens curve to look at the yield curve buried at minus 50 basis points, right? It's steepened from minus 100 basis points, which has been historically
Yeah.
blown out, and it's really difficult for me to trade with the curve that blown out because I haven't seen levels like that before. But with the curve buried at negative 50, negative 60 basis points, we have to be conditioned to expect these economic snowballs to come through the window and stresses to appear, right? That is not a sort of default setting for the twos tens curve, right? It's rather depressed. So that's really tricky to me with an eye on that though, and the fact that I think it is reversing. I think that the S&P can work its way higher a little bit, and I think that because Patrick, what seems to me that the most consensus view out there is that we will have a recession in the U.S. Fine, I can live with that. I don't even want to argue against those people because it seems possible. But that recession also means that the S&P has to back off dramatically because earnings will go down, right?
Yeah.
Totally fair assessment. But I think that's a very popular view, number one. Number two, if you ask me, I believe that the S&P bottomed on this move, quite honestly, last year in October when we had that dip down to 3,500 and the recovery to 3,600. If you remember, it was shortly after we had two headlines of negative GDP growth,
Yeah.
right? And to me, that was the market seeing and kind of shitting itself on the recession that was coming,
Right.
right? So now, if that sort of, and not to mention down there, we had, and Jared Dilling was really good at pointing this out. We were in this bubble of negativity in stocks, the likes of which, like, I hadn't seen before. Like, people were so negative stocks because rates were going higher and we were fighting inflation, and it was like, guys, it is over for this S&P run. And very easy to think that. But as you see, we've made it out of that. We've made two higher lows. We've carved that double bottom that you pointed out in December and March down at 3850. And now for the third time, we're up here at 4200. What's the problem this time? We've still got bank stress, right? So I think left to its own devices, sort of market versus economy, the S&P would do just fine here, and it might do just fine even in a rising or sideways rate environment. But with these bank stresses constantly bubbling up, it's just going to take longer for it to dig itself out of this hole. And it may actually turn things around. It's not a view that I can marry, but it's a view that I can trade off of right now since we've got this double bottom at 3850. We've rallied to 4200 again. Everybody's still bearish for the same reasons. And I just feel like the S&P can kind of grind higher and take some people by surprise.
Well, thanks for your update. So let's actually take a look. You sent us a bunch of charts that you wanted to talk about, and so I love talking charts. So let's dig into it. The first chart you sent us was the 2-year yields, and what's your thinking here?
So you can see that big slide, Patrick. Obviously, in the first week in March, there was that huge reversal where rates carved a new high in 2-year yields above 5%. That was Jerome Powell sitting in front of Congress saying that the terminal rate in fighting inflation was probably going to be higher than the market expected, right? Bonds dumped, yields go tick a new high. And the next morning, we wake up to Silicon Valley Bank blowing up, right? Obviously, there's a massive bond rally with that bank blow up, yields go tumbling lower, and it turned out we had a 12 standard deviation reversal in yields when they traded 4% 3 sessions after that new high they put in, right? So for
Right.
me as a trader, that is a tremor that should sort of hold, meaning that's a good high in yields, otherwise known as a good low in bonds. So I want to
Right.
sort of play that bonds from the long side. I want to play yields from the approach that was the reversal, right? We had yields climbing higher from SEP 2021, when they were at zero, straight through to 5%. And then we had this massive reversal. So as a technician, I'm playing this from the angle that yields will now be heading lower. And I just use the 2 year yield chart because I feel like that reversal is really, really, really stands out in the 2 year.
Now, do you think that the 2 year movement is going to be driven by inevitably the Fed having to ease like a bull steepener that sends this
Yes.
2 year bond higher?
Yes, exactly. Exactly. That's exactly how I'm looking at it. So and if those yields back up, this chart could prove me wrong, Patrick. If we get a couple of sustained closes above 4.25%, say above that 50 and 100-day moving average, as a technician, and we've tested it a couple times, but as a technician above there, I have to be concerned, right?
Yeah.
Because in the back of my mind, I know that the inflation, beast is still out there, totally, not completely tamed down to zero. So that could rear its head again and cause upward pressure on yields. I'm still just going with the fact that the economy feels like it's weak enough. It feels like the narrative and, everything in the rates market is going that way where yields can head lower now. So I could be proven wrong, but that's the way I'm working. And if you want to go to the next slide,
Yep.
I'm
Let the
working off.
mortgage rates.
Yeah, exactly. I'm going off. Now we're going to go to the long end of the curve where we've seen two lower highs, and we're kind of meandering around the moving averages now. But if I'm going to continue with this bet and this sort of assumption that yields are going to head lower, I'm going to bet that the mortgage rate is going to be sideways to lower from here, right? So that's a kind of bet that to lead me into the next bet that I'm making. And I want to sort of say that the mortgage, 30-year yields have to stay kind of stable for this trade to work, because I'm going to tell you how I navigated my clients into the home builder sector. Right.
Right.
That's the sort of that's the spoiler alert. That's the last slide. But so when you see yields stabilize, Patrick,
Yep.
if you want to go to the next one, you'll see how as yields stabilized, the builders took off. Right. So here's Pulte Homes versus the S&P, and as yields stabilized, they just went out and galloped ahead of the S&P. Right. To me, that is still a sort of I'm not an economist, but that's still a sector that is seeing follow through strength from all of the moves that happened and all of the construction that went on, sort of courtesy of the lockdown. There were still
Yeah.
people moving their homes, which I think is still going on. There's still people doing construction. There's people upgrading their homes and everything. And so there's a general trend in the country, I think, where that's really supporting this trend. Right. So with them really outperforming S&P, you're hearing the home builders, the individuals like Pulte, DR Horton, NVR, Lennar, they're all beating earnings and they're all rallying sharply. If you go to the next slide, that's
Yeah.
DHI versus the S&P, another stock that has just detached itself from the sort of, the daily story of the S&P and gone on a bull market of its own. So when I go and I compare, if I'm looking for a sector that I'm going to trade, it's like, okay, let's trade the whole sector and let's trade ITB. And if you chart ITB versus the S&P, and ITB is generally, Patrick, the that is the hold on,
The basket of home builders,
yeah, the basket of home builders. I was just going to
the
say,
ETF.
who's the ITB creator of this ETF? That's iShares.
Yeah.
iShares Home Construction ETF. Basically, half of that ETF is home builders. It's 15% DR Horton, 13% Lennar, 8% NVR, 7% Pulte Group. So that's 40%, 44% of the ETF right there. So you're essentially long home builders. Um, Given this dynamic where 30-year mortgage yields finally leveled off, I feel like if they back off, these stocks are going to get even more juiced, right? So they've clearly broken away. They're trading trends of their own, which is, this is my kind of market. I feel like, Patrick, where the
Yeah.
S&P may be sideways, but within the S&P sideways churn, I can identify the fact that currently natural resources stocks are lagging a little bit, tech stocks are leading a little bit. You're seeing home builders and gold miners get out in the lead, and that's kind of how I trade. I kind of bet on the horses that start leading on the year, and I kind of bet on them to finish well throughout the year in different ways, right?
Right.
When I feel like I find those bull trending sectors like home builders, I'm going to trade it like anything else. I'm going to try to buy dips and sell rips. But at least they're
Oh,
presenting themselves, right?
it's funny because Kevin and I in the last talking charts were talking to home builders, and I was the one shitting on the home builders, and Kevin was the one defending. So you're in
Oh,
the
interesting.
Kevin Muir camp,
Oh, okay.
and which is awesome. I'm sure he's going to be excited to have you in his camp. But
Yeah,
like for me, it was always a little bit of a struggle because like I think that there's a cyclicality to things like the automotive stocks that are vulnerable or at least correlated in a sense that they're interest rate sensitive and economically sensitive. And it's interesting to me how the home builders were so much stronger than autos,
yeah.
and I would think that the two would have correlated, but obviously I was wrong. And
Oh, yeah.
anyway, but
Well, that was a viable trade to hunt down, though. I know exactly what you're talking about, and it could have gone the other way, where the autos took over and the home builders sagged. I've seen that happen before too. So
do you know? On the this chart here, you have the ITB itself. Are you thinking home builders make a 52-week high here, or what are you looking for out of this trade?
yeah, I still need some time, Patrick, for this to work out. But if I'm going to sort of plot something out over the course of the year, and try to have try to have an animal to hunt. When I'm looking for trades, Patrick, like I'm so much better of a bull market than bear market trader, right? So I'm always clamoring to have things that I can sort of confidently trade, or at least within my view, confidently trade from the long side. So when I find this sector that has the double bottom was the first thing that tipped me off last year, saying stocks feel kind of weak to me, but it was kind of strange that home builders held this 50 level and rallied. It was a reasonable pullback from that whole rally that they just put in from 20 to 80, right? It looks like about a 50% pullback. And when you believe in the trend and you kind of see it going on all around you, now I know that I don't live in sort of everywhere USA out here in Atlantic Beach, New York, but the place is a giant construction site. I
Right.
mean, I can tell you that. So, and I feel like I'm very sensitive to seeing that everywhere I go. And it seems like everywhere I go in the States in my travels, every place is getting blown up.
Right.
So with that in your back pocket, I felt like maybe that is the right trend, and that's the right secular trend to hunt. Maybe that's why these are one of the few sectors that are now positive on the year and kind of bubbling toward the top of the leaderboard, where they're catching up to semiconductors and big tech. So this is where I'm taking my swings this year, Patrick.
Absolutely. And I'm just curious about your trading framework. When you create an investment theme like this, what is it that you're looking for to, if the trade isn't working, like what would you have to see in this in order for you to kind of change your mind or say that maybe this isn't the trade I was looking for? Like what would it, in this case, in
Yeah.
the home builders, what kind of what would you have to see
Yeah,
basically for
sure.
us?
Absolutely, Patrick. So my strategy, like I could have put one more chart on here where I may have expanded um, on that ITB chart and drilled in on the rally that we're seeing sort of from the end of 22 into this year, right? So we're seeing a clear, what's critical about that is that that's where at the sort of end of last year is where home builders retook their moving averages and resumed their trend, right?
Right.
You could pretty much see that clear as day. As soon as it cleared the 200-day down at $60, it was like, okay, we're going to bounce off the 50-day a couple times now and trend higher. So what would take me out of that? I've got like a channel drawn that I think that this trade can stay in, give or take, over the course of the year. Yes, I do think that drives it toward that double top at 78, 79, wherever that is there. Oh no, excuse me, that's above 80.
Yeah.
Yeah, so that double peak above 80. And what would take me out of it, Patrick? A couple of consecutive closes below the 50-day. I would sit up in my chair when that white trend line that I drew broke. That's even steeper than the 50-day moving average. I would be, and in addition, Patrick, this is the kind of thing that when I'm in and it gives me any kind of a gap higher opening to a new high, that's when I participate and sell.
Right.
Even though I'm trading it from the long side, those are the opportunities that you get to cut your book down, and that's where you take some off and then try to buy it back cheaper. So I've been kind of navigating that fairly well since the trend resumed. And I would say right now that somewhere below 69.40 on a couple of closes, that's where I'd say, okay, I'm bailing out on this. This is run its course and I got to get out. So
Oh, that's awesome.
if I keep that trailing stop close to the markets, I feel like my give back, my give backs from the high water mark aren't that bad on the trade. And that's kind of how I look at it.
Oh, there you go. Well, listen, Tony, I don't know. I don't think we even gave you enough time to drink your beer, bud.
I know. I'm taking 2 sips here, but at least I got something to work on after we hang up.
There you go. Well, listen, Tony, we're keeping these fast and furious. So listen, can you just share with all of our listeners where they can find you and what you do and how you do it?
Yeah, awesome, man. Thank you for that. At Twitter, you can find me at TG Macro. Very simple. My website is at tgmacro.com, and I've started a pretty cool new offering on called Navigator TV that you can find on Substack. So you can find me at tgmacro.substack.com, and that's where I put out free video and audio content on the markets. I do updates. I do pretty much every weekly updates on what's gone on in the markets. And I just started adding some interview clips there from the interviews that I do with some of my clients behind the paywall.
Well, that's awesome, Tony. Listen, thank you so much for joining us, bud. And now that we have this new segment, hopefully you join us more often, bud.
Oh, I'd love to. Maybe we'll see if I'm right or wrong in the home builders one day and look back on it, Patrick. That'd be amazing. Right?
All right. Well, thanks for joining us, bud. Cheers.
I'm grateful of you having me. Thank you so much.
Thank you. Thanks, everyone, for tuning into the Market Huddle Plus. We appreciate you spending some time with us. And listen, you can never have too many friends. Bear market or bull market, we're just happy to spend some time together on this crazy ride. Cheers, everyone.